Hi, Annette.
Hi.
Welcome.
Good.
How are you?
Good. How are you?
Good. Thanks for coming back.
Yes. Happy to be here.
Yeah. So a lot of people come to me and they want to buy a house or buy their next house or whatever, and a lot of the questions revolve around the money, and that's tricky for me because I'm not a loan officer. So,
Right.
what I was hoping to do today is kind of do my best to keep the universal that perspective in mind, and just kind of talk about what goes all into this because. I mean, people know they got to save up money and fix their credit up, but after that, it's amazing how many people come to me and they're like, "We think we're ready," but no one has any idea. Yeah. So
as far as like pre-approving or like the steps that they would need to take to
Exactly. Yeah. I mean, it's I mean, if you have thoughts on that, go for it. It's I mean, I get a lot of people that come to me, like I said, that I've saved up, call it $30,000, and I know my credit score is at least 700. What do I do?
Yeah, I mean, that's a great start. So, I mean, then, their next, step is to call us so that we can plug in all of the other things that go into a pre-approval. Some people think, well, I have this saved or I have, good credit. That should be enough. But it really isn't. There's so many pieces that have to come together to make it work. So, we're looking at employment history. We're looking at income. But all income isn't created equal. So, a W-2 versus a self-employed, some people think they make more money than they actually do.
No doubt.
But even the number of hours they work or how they're paid will, be taken into consideration. And we may not be able to use that income until a certain period of time. So all of that needs to be vetted out. So, like, if somebody is looking to buy a house, they need to come to us so that we could tell you, we may need to, wait a little bit or, this is what we have to work with. But what we have to work with may also determine their eligibility for price point.
Sure.
So they may want, say, $300,000, and we're like, well, today you can do 2. So if you want 3, you may have to wait or save more money.
Sure.
So just giving them all of that education after we see all the pieces, because I have people, tell me, well, if I have this and this and this, tell me what I qualify for.
Yeah.
Well, I have to see it. Like,
Absolutely.
I could give you an idea, but like to actually give you a true answer,
Sure.
I need to see everything so I can plug in all of that information to determine what they'll actually qualify for.
Sure. And yeah, I mean, to no fault of their own, a lot of people are doing their best to do research before they land in front of a loan officer.
Right.
So this one I get a lot. What are some reputable sources to check your own credit score? Because I know there's the Credit Karmas of the world that, like, a lot of people are very religious with that, and I believe that that's not often accurate.
Well, FICO, like
Okay.
my FICO, I think it is, use a FICO. But a lot of credit cards now have like credit-wise.
Okay.
That is a better indicator of where your credit score is. That updates every single month.
Okay.
I think it is pulling a lot of, things that we're actually pulling.
Sure.
It might not be 100% accurate, but it's way better than Credit Karma.
Sure.
So, and it's a free option when you have a credit card. So like my Capital One, I have my credit. As soon as I log in, I see my credit score.
There you go.
So it's a good indicator.
Those are pretty accurate. Okay.
They're pretty close.
Yeah. Okay.
Yeah.
Okay. Yeah. I use Amex and I check it probably too often, but
And they'll tell you every month. I think when the credit card statement comes out, it'll say like, "Hey, your credit increased or your credit decreased," and it's usually a utilization on any given day of like when it's reporting why it's going up or down.
Sure. Totally.
Yeah.
So that's another one I hear commonly is people a little nervous around the hard credit pull that comes with this. So A, do you have thoughts on that? And B, where does that credit pull happen in relation to everything else around it? Like I come to you and like you said, people say I have X, Y, and Z. Like where does that play in?
Once we do the pre-approval, like when we send out the application, there is a question, do you give us permission to run credit? So we're pretty much doing it right away.
Okay.
It is a huge piece of that pre-approval.
Sure.
The credit score, the credit utilization, the credit history, the amount of debt on there,
Sure.
all determines, what we can do. So we're pulling that pretty much right away.
Sure.
As far as like how it's affecting someone's credit, I mean, it's very light. It is a necessary piece to doing, the pre-approval.
Sure.
Credit bureaus know that, so it's a light hit. Also, you're able to shop around. So if you pulled it with me today and you go to XYZ tomorrow, it's pretty much the same pull. It's not going to hit them again. It will show as another inquiry, but it's not another hard hit. They,
Sure.
I believe, allow you up to 45 days to have other lenders pull for a mortgage inquiry where it won't hurt you.
Okay. Well, that's cool. Yeah.
So that because you should shop around, like kind of like same thing with cars. Like
Right.
it's it's not such a hard hit. When people tell me, well, so and so pull my credit and then you pull my credit and it's decreased, it's not the mortgage pull that's doing it,
Sure.
because creditors will report any given day what that, like if they have multiple credit cards or different loans out, they're reporting on different days of the week of the month.
Sure.
So any of those things could change that credit score. It's the utilization, like I said. Any other a late payment, something else is going to affect that score, not the mortgage pull.
Sure. So I reach out. I want to buy a house. I want to get pre-approved. You do that credit pull, and that's like you're doing that pre-approval based on that snapshot that's being taken right
Yeah.
then. And you got to, I as the borrower have to do my best to keep everything as good or better throughout that process.
We tell them to be very vanilla after pre-approval. Do not do anything.
Okay.
Do not take out new credit. Do
Yeah.
not increase your balances. Do
Sure.
not change your job. Do
Yeah.
not,
Yeah.
put large sums of money in your bank account.
Right. Yeah.
Because any of those changes from pre-approval to actual application
Yeah.
could kill a deal.
Sure, totally. And that's, I mean, the famous one is people excited, they get an accepted offer, they go out to Raymer and Flanagan and they open a credit
Yes.
line to get their new couch.
Well, I
and then-
wanted furniture.
Exactly. Can't have it.
No,
Can't have it.
not yet.
Yeah, don't do that. So, talk to me about work history a little bit. You did my mortgage when I bought my house. Thank you.
Yes.
And I am an independent contractor, so that probably wasn't the easiest thing in the world. But so, like, in speaking about mortgages, usually people are talking about a W-2 employee with X amount of work history and
Yep.
such. What if somebody is completely self-employed? What are they looking at to get set up for a mortgage?
We're looking at 2 years tax returns.
Okay.
So, and what we're looking at is the net income after all the expenses. So what you're grossing, what you're putting, so say you're an LLC and you're doing it on your personal returns.
Sure.
You're going to see, your gross receipts, but then you're going to write off all the things.
Oh, yeah.
And then there's a net number. That net number is what we use for qualifying.
Okay.
So when we
The
ask,
last 2 years average of
and then we average the last 2 years.
Okay.
Now, if in 22 you made a certain dollar amount and then it decreased in 23, we still might have an issue because we have a decline in income. Would have to have an explanation. Why did you make this in this year and this in this year?
Okay.
Because that could, trigger, or, maybe look like there's trouble in the business.
Totally.
So unless there's a valid reason why it decreased, we may be, in trouble.
Sure.
If somebody's in business for more than 5 years, a lot of times our underwriting will only ask for 1 year. So that's
I did not
sometimes
know that.
nice.
Okay. Yep.
So it just depends on the business and, what our underwriting engine says.
Sure.
But we are typically looking at 2 years tax returns on the net income.
Okay. Yeah, so right off, sir. Can
Yes.
be bad in that.
And that's
scenario.
what, and that's
Yeah.
it. They're like, well, I make, and I'm like, yes. And then what you're paying Uncle Sam is,
Yep.
that's what we have to use.
No doubt.
Yeah.
No doubt. Okay. And on the work history thing, so I guess 2 scenarios for you. Let's say I'm a car mechanic, and I've been making $50,000 a year for the last 3 years, and last month I started a new position at a new company, but I'm still a car mechanic, and I'm now making 90. Do I have to wait 2 years for that?
No.
Okay.
Well, I guess it depends. It depends on how you're paid. If you're a W-2 and you're going to be working 40 hours a week just
Yep.
at a new place in the same line of work,
Yep.
we can use that income right away.
Sure.
40 hours, they can verify you're full-time,
Sure.
new income, perfect.
Yep.
We'll ask for pay stubs, but we can use that income.
Sure.
If they become varied in their hours, we may have to wait.
Sure.
Because it's a different job or different employer, and if there's not like a guaranteed set of hours and it's varying, we may have to see like what they're averaging over a course of time, which is
Sure.
usually a year.
Yeah.
If they go contract, that's
1099.
considered
Yeah.
self-employed, and we'd have to wait 2 years.
Okay. All right. Interesting.
Yep.
What about somebody, similar scenario, but they were working part-time at the same company in the same position for a long time, and then they've recently switched to a full-time position? Can we go just off of that full-time income?
Yeah.
Okay.
I mean, as long as we have a verification saying they are now full-time, they're 40 hours a week.
Sure.
Yeah. we could use that full-time income.
It seems increasingly as time goes on, people have a small set of part-time jobs compared to one full-time job.
Right, and unless you have 2-year history of holding both of those jobs, we can't use both of them.
Really?
So sometimes we can use one of them,
Sure.
but not both.
Totally.
So that will obviously impact their qualifying.
Yep. Okay. This just came to me as curiosity, and we can totally clip this out if we need to. But let's say somebody happened to come across $50,000 in cash some point in their life. You know, they saved it up from their paperboy tips or whatever. That's got to sit in the account for a while, right? You can't literally save up $50,000 or whatever amount of cash and then go to the bank and say, "Hey, I have this. This is what I want." You can't do that. It's got to be.
It has to be seasoned.
Okay. Yep. Okay. All right. Fair enough. So similar to how we started, people come and they think they're ready, but they don't even know where to start. So what would somebody, not even necessarily a first-time home buyer, but in general, somebody that's looking to obtain, even if it's a refi or they're going from one house to the next or whatever, what should somebody be looking for in a loan officer and really like the best program suited for what they're trying to accomplish?
Well, again, it's going to depend on everything that they bring to us. So when we are looking at it from, the income, credit, and asset standpoint. So we'll look,
Sure.
And if they're first-time buyers versus a repeat buyer.
Yep.
If they have money to put down, we'll look at conventional first, see if they fit the mold. But a lot of times people need down payment assistance or they need, help with closing costs, so seller concessions, or their credit is, less than perfect, so we're going to be looking at FHA maybe.
Sure.
So it's going, we're taking all the information and then determining what will be best for them at that given time.
Sure.
Based on, what we're seeing.
Sure.
So, most of the time our biggest problem is assets.
Sure.
So, we're looking for the lowest down payment, the lowest, cash to close, whatever down payment assistance we can find.
Sure.
So yeah, we're kind of, steering them to wherever we think they'll fit best.
Okay. Fair enough. And what would be the bare minimum required credit score to buy a house, and what gets you into conventional?
Well, typically we like to see 620. There are other lenders that will go as low as like 580, even I think 500 some places. We're not quite there.
Yeah.
So, it just depends. But on top of the credit score, like it's the credit history. So like you might have a 650, like we're seeing even conventionally, like you can have a 750 credit score, which perfect. That's great. Yep. But if like their utilization is high, so they can pay everything on time, but if their utilization is high, it may not run conventional. Sure. So we run all our conventionals because there may be one little thing that it will trigger conventional not to work.
Sure.
Or if they don't have like a housing payment currently, so they're living with mom and dad, and they have no housing or history of housing payment, and they want to go and buy a house that they're going to have a $3,000 mortgage payment.
Sure.
That might, it looks at everything. So like there's not like any perfect score for conventional either. I mean, because we can also get a 680 sometimes through.
Really? I did not know this. Yeah.
If they have, the good credit history. So, pricing is affected by credit score on conventional a little more. There is a pricing grid. So you may see, a lower credit score, even though it goes through conventional, may have a higher interest rate.
Sure.
And it's just based on risk.
Sure, of course. Yep, like anything else.
Yeah.
So that's, you touched on this a little bit, but I wanted to talk about DTI. Debt to income. And so I want to take a stab at my understanding of it. I'm sure it's flawed. But so when qualifying somebody for a mortgage, lenders are largely looking at what's going on month by month for that borrower, right? So your debt to income means how much are you making and how much of that is already going out in fixed expenses.
Right.
And how much meat on the bone is left for, odds are when somebody's buying a house, their cost of living is going up a bit and stuff like that. Yeah. So that's the important one. Like and like I said, I think you touched on this, but like I make $120,000 a year hypothetically, but if I'm spending $119,000 of it, and that's where people get into trouble.
Yeah. Well, and that's it. So we're looking at the monthly obligations on the credit report. So if you have a car loan, the student loans, credit cards, and every credit card has a minimum monthly payment.
Sure.
So you may have $500 on this one, a minimum payment of $50. All that adds up.
Yeah.
So we're looking at everything on the credit report. Anyone that has child support or alimony or any other, monthly obligation.
Sure.
We're looking at the new housing payment, like what the principal and interest, taxes, and insurance will be. And then if they have a current house that they want to go non-contingent, we're looking to see if they qualify with that existing debt as well.
Sure.
We're taking all of that divided by what their current monthly income is. Now, we're looking at percentages. So conventional, we don't love to go over 45. I mean, sometimes we can get to 50 with, compensating factors, but 45 is usually, where we want to sit.
Sure.
FHA sometimes will allow us to go up to 55. So there is a little more leeway with FHA, and it does give them a little more buying power by doing that.
Sure.
Again, it will just depend on what our underwriting engine spits out at us.
Absolutely.
VA has a different way of calculating debt to income. It's called residual income. Okay. So they're looking at, again, everything on the credit report, the housing payment, but they're also taking into consideration like utilities, there's like a calculation for utilities. They're taking out the taxes on your gross income. If you have daycare expenses, they're taking all that into consideration. And then at the end of that, if there's a certain dollar amount, and it's based on family size, they'll say, well, if you have a minimum of this still left over after all the expenses, then you're meeting the residual income test, and usually we'll go through. So we've seen debt to income like 55 up to 60% go through because they're still meeting the residual income test.
Right. Interesting.
Yeah.
That VA, I mean, I've sold houses to veterans before that say, I want nothing to do with that because they have bad experiences with the VA otherwise. And I'm like, you should really think about that. Because if there's
financing.
Right, yeah, 0% down. It's
Yep.
Yeah, great program. Do you know anything about USDA loans by chance? This also just popped into my mind. I started springing on you. But
I do. I mean, we do. I don't do a ton of them.
Okay.
I mean, we do offer them, but
Sure.
I don't do a ton.
So USDA loans are 100% finance, which means 0% down. I'm sure there's still closing costs and what have you.
Yeah.
But it's got to be in certain agricultural areas and stuff like that. But in theory, somebody could go buy a big chunk of land with a house on it, 0% down if they wanted to.
Correct.
Yeah.
There is an income limit on that, so it's based
Okay.
on family size again.
Yep.
They do look at credit history. They do look at how many trade lines you have. So, like, if you have light credit, it may not go through.
Sure.
But, yeah, I mean, it is a great program for, those specific areas that it's allowed to be done in.
Yep. Okay. Cool. I like it. I'm sure you're so sick of this question, but what do you think about interest rates in that?
Well, they're coming down.
Yeah.
I mean, they're slowly trickling down. Will that stay?
Yeah.
I mean, there's so much volatility still. I mean, there's an election around the corner.
Yeah.
What we see is that they are trending down.
Yeah.
The Fed is supposed to cut rates next week. That's kind of already baked into our current rates because that's what is expected right now.
Yep.
Like if they don't do it or if they do more than what is expected, we may see a change in rates. But
Sure.
right now it's kind of already baked in that they're going to cut that rate in September.
Totally.
They do expect, I think, 2 more cuts in November and December. That's what they're anticipating. I don't know if that's going to happen. So right now we're kind of, I mean, they have come down in the last few weeks, so they're like more in the 6s.
Okay. Yeah, and for context, I mean, this is September 2024 right now, and I mean, yeah, I bought my house in 21, and I got a 3.125 now. A lot of people either bought or refied their way into something like that, and
Yes.
I've talked at length on videos like this about how that's what's causing a lot of this slowdown and yada yada.
Yes.
But yeah, at the the end of the day. This is, I almost asked you what you think a normal interest rate is, and that's not fair. But like, I operate under the assumption that 3 or in some cases even sub 3%, that's not happening again.
In my opinion, no.
Okay.
And honestly, that 3% was in a time, or 2.5%, or that was in a time like our economy was not well.
Yeah.
So like when people, say like they want those 3% too, but they're waiting, like that means something else is going wrong. So like look at all the inflation we've been dealing with. Like that's like a repercussion of what was happening during that time frame.
Yep.
So you may not be paying it in a housing payment, but you're paying it everywhere else. So do we want 3s and 2s? I don't know.
That's an interesting. I've never thought of it that way.
Yeah.
That is no doubt. And that's actually, why don't we just dive right into that, because we so I had asked you before we sat down to do this. So many people say, I think I should qualify for about $300,000. It's like, wait. Like, and I think it's funny, and you guys are great about this because you have the mortgage calculator, but I think it's so funny that banks issue a pre-qual that says you qualify for $250,000. And it's like, you need to know so much more information than that. Like, so,
right.
So on the topic of interest rates, we were talking a little bit how as interest rates go up, the competition didn't go away over the last 2 years or so, which is so true. We all thought that was going to be the moment.
No.
And it didn't happen. So buying to someone that says, I want to go buy a $500,000 house today, but maybe I'm going to try to sweat this out for another 12 months or whatever. What are your thoughts on that?
No.
Okay. Great.
So
we'll end it here.
Yeah. So people have been on the fence. Yeah. People are waiting. People are waiting. They're waiting for that sweet spot. And there is a sweet spot. Okay. But we've seen that competition. Like you said, like prices haven't really cooled. Yep. We're still seeing, competitive offers. But that's still at 7%, 8%. Like we're still. So just an example. If someone bought a house today at 7%, $200,000. Okay, perfect. So their payment's going to be somewhere around like 13 for principal and interest, $1,350 or something like that. Okay. Now they're waiting. Or now another friend is waiting, and they're like, I'm going to wait until they're 6%. Now they're 6%, but they're waiting on top of everybody else that's waiting. So now we're going to see this influx of competition. Right. What do you think that's going to happen? Now there are going to be more competitive offers, and they're going to have to jack up the price. Right. So that $200,000 house is probably going to be now $250,000. Right. And so even at $250,000 at 6%, they're paying almost $200 more for that payment. Right. So if you get in now, even if the interest rate's higher, you still get the advantage of the price, and you can always refi down the road. Right. But you don't have to overpay. So that person going in at 6% paying more may be stuck with that rate for a while. Right. So who knows? But but you're also going to be just know that there's way more competition out there. There's been a lot of people waiting. So you think you're waiting for that 5-6%, like so is everybody else.
Everybody else. Yeah. Okay. So I want to dissect that a little bit. So we're talking about principal and interest. So somebody's total monthly payment is also going to include property taxes and homeowners insurance and what have you. Yeah. So we're talking about just what you're giving back to the bank. Yeah. So today, roughly 7%, probably a little bit less. $200,000 would be roughly $1,350 plus whatever taxes and insurances. Yep. Okay. And if it goes up $50,000 from there, but the interest rate goes down 1%, down to 6%. Yeah. Then that's still going to be $200 more per month.
It's about $150.
$150 more per month. Okay. Mm-hmm. So, So if you are waiting for interest rates to come down, you also have to hope that the market demand will go down with it. And the odds of both of those things happening at the same time.
Very unlikely.
It's very unlikely. Okay. Yeah. And that's,
because we don't think, just because the demand is there, like I don't think inventory is going to catch up. Yeah. I don't know. Like it just seems that we've had such an inventory problem for so long that I don't think all of a sudden there's going to be that many more houses on the market for the demand that's going to be out there.
I agree. Yeah, it's. It seems to be slowing down over the last, call it, month and a half, something like that. I think the NAR changes have some stuff to do with that. But I have always thought that a 3% mortgage rate was kind of like winning the lottery, and you could certainly hang out. I'm going to do it. I'm going to hang out in my house for a long time. But the idea that there, obviously it has to make financial sense when you're making big moves like this, but somebody that's cramming themselves into a house that doesn't work for them anymore just because they're hanging on to this 3% rate when they can double their square footage, and
Right.
you're signing up for today's 6.5%, 7% rate, but like it's not going to get easier over the next couple of years. It's not going to happen.
No, and why would you? Right, like life happens. Life changes happen. You know,
Exactly.
there's marriage, there's kids,
Yep.
there's death, there's divorce. Like,
Yep.
so there's going to be many reasons you're going to want to move. So, right, holding on to a house just because of the interest rate is
Yep.
silly.
I already won. You already won. you
Yeah,
got way
right,
ahead.
right.
Things kept it. Yeah, exactly. So, okay. And so this really is, I probably should be more in the loop on this stuff. But I'll probably be hearing a lot of this for the first time. I understand Premium has some pretty creative products around, especially around things like I already own a house. I want to get into my next house. In a perfect world, I have a whole bunch of equity that I'm sitting on here, stuff like that. So maybe... What does it generally, if somebody already owns a house and they want to get into their next one, what are kind of your first couple questions for that person? And am I even in the right ballpark with the creative programs that we're talking about?
Yeah. Well, I'm going to ask, do you want it to be contingent on your sale, non-contingent on your sale? Most people are going to say, I'd love to be non-contingent.
Yeah.
And then do they have equity? And if I see like there's room in their income or debt to income ratio, we do have what's called a bridge loan, which you can tap into your equity that you currently have prior to selling. So
Okay.
we're basically giving you a short-term loan to put down some of your equity on the new house without having to actually sell. It is meant to be a short-term loan. There is an interest rate. There is,
Of course.
payment
Yeah.
over time,
Right.
which is then just paid off after the person sells their house and closes.
Sure. So this is for somebody that is in a good position on their current house, but maybe doesn't have a ton of cash on hand.
Right, and then you could borrow against your equity.
Okay. And what happens if, when you do that, the next house doesn't close for some reason? That just stays in a short-term
Well,
loan?
it's
and you
yeah.
can-
I mean, they're just going to accrue interest until they
Sure.
sell
Figure
it and
out.
close it.
Okay.
Yeah.
Yeah. Okay. And then I've heard about some kind of cash guarantee situation.
Do you have a cash guarantee?
Okay. That's a ballsy.
Essentially, again, it's for high qualified buyers.
Sure.
So
What is
we're-
a high qualified buyer?
So we're looking at a lower debt to income ratio, higher credit score.
Okay.
Someone that has assets, good employment. We're kind of vetting that out that like nothing's really going to go wrong.
Sure.
Hopefully during that 60-day period that we're working on the financing.
Mm-hmm.
So we're vetting everything out.
Sure.
But there is a risk to this program, so we also are educating the customer. So you say you're doing the same as cash, but getting financing, it's the same as cash. So
Right.
you're putting a 20% deposit down, and you're guaranteeing the appraisal. So whatever you're offering, you're basically saying, yes, we're doing an appraisal for informational purposes only, but you're guaranteeing no matter what it appraises for, or if there's like any repairs that come back, or like that's on you.
Okay.
So that's a gamble.
That's a gamble.
But you're essentially telling the seller, like, we don't have any contingencies on this deal. There's no sale contingency. There's no employment contingency. It is a clean deal that's going to close. And the buyers know all of this before they get into this contract.
Sure.
Because if they walk away, we're keeping their 20% deposit.
Right. Okay. So you're. I want to buy a house. I'm a strong enough borrower that I can qualify for this cash guarantee
Yeah.
program. So when I go to make an offer on a house, I'm basically telling the seller that this is a cash transaction.
Yes.
I will be obtaining a mortgage.
Yes.
But it is not a contingency of this deal.
Correct.
Interesting.
Yeah.
Okay. So, and in the event that I offer to pay $400,000 for a house and it appraises at $385,000,
You're saying too bad. Or you're just saying, okay, I'm coming up with a difference, or
I, the borrower,
Yeah.
would have to have the cash difference
Yes.
at that point.
Yes.
Okay. But that's, I mean, I work with some pretty qualified buyers, and they get steamrolled by cash offers, and that's really tricky. I imagine it's quite deflating too. It's hard enough to qualify to buy a house. If you're a very strong, that's got to be exceptionally difficult to get there and walk into a house that you really want, and then find out you lost to somebody who saved up $350,000 in cash. That's crazy. That's still a program. If you're up for as the borrower, or if you're up for the same risk. Amount of risk as if you were buying it cash.
Well, and to a seller, it's almost better than a cash deal, I guess, because they're almost guaranteed the closing.
Sure.
So a cash buyer can still walk away.
Sure.
So
they lose a deposit, but yeah. But but as part of this cash guarantee program, you Premium Mortgage are taking a 20% deposit.
20%. Like they have skin in the game. Like they are
before they even make an offer.
Well, no, they're putting it's the EMD.
Okay.
Yeah.
Wow. So
yes.
If I want to buy a $400,000 house with the cash guarantee pre-approval, then my EMD is $80,000.
Correct.
Oh,
right.
Okay. Well, I mean, hey.
But I've done probably 5 or 6 of these this year.
Yeah.
Wow. And they have won over cash and weren't the highest offer.
Okay.
So
why would without being the highest offer, why would a seller take that? Are there more assurances baked into this?
They feel more confident that they'll close than maybe sometimes a cash buyer.
Sure. Okay. Yeah. Totally.
Yeah.
Cash buyers do get squirrely, especially if they have not a lot of skin in the game.
Correct.
At that point.
Right.
Yeah.
So if you're putting a $5,000 deposit down, I found a better house. I'm moving on.
Yep.
Yeah.
I've been asking for that a lot lately with listings, is higher deposits, because odds are you're putting down. I mean, that's an important one too. I've probably said this ad nauseum into this camera, but the 2 numbers you're worried about when you're buying a house with a mortgage are total cash to close and monthly payment. That's like your total cash to close includes down payment and all your closing costs. And like people, I tell people that are buying a house for the first time that we have to tell them what their deposit amount's going to be, and they confuse that with down payment.
Down payment.
So.
Well, that's where one of our tools comes into play. Quick Wall.
Yeah, love that thing. I love it
because it is so transparent to the customer, but it's so good at the same time, because when we're setting those parameters and we're sending that calculator to the customer, like they can't tell us that they were surprised about a payment or funds to close, because you have access to input the price, the taxes, the down payment into your calculator and see what a mortgage payment is going to look like and your funds to close before you even make an offer.
Sure.
And you're probably having that conversation with your agent as you're writing up the contract too. So everyone's going over that with them. So for them to be like, I wasn't aware, you're like, there's no way you weren't aware.
No doubt.
But like that tool, that's probably one of the best tools that I've had in my career.
It's exceptionally helpful for me out in the field when I'm standing with people looking at houses. And we should probably add context. So a lot of banks, when you go and say you want a mortgage, they hand you this, you qualify for X amount, and
right.
Good luck. Call me when you need me.
Yeah.
This is something so anybody can go on mortgagecalculator.org and get rough numbers, but this is something that takes all the things we talked about today, debt to income, credit users, all that stuff, and this is an actual calculator to the penny, or maybe the dollar, of what the monthly payment total cash close is going to be if you make X offer on this house, including property taxes, insurance, all those tiny little variables.
It's specific to that customer. Like, that's your letter. That's your calculator.
I can issue them on the fly. If I'm writing off at 10 o'clock at night, I don't have to call you. That's awesome.
Right. And you could like, hey, 5 more thousand. It's only a couple bucks. Here you go. Look at it.
Exactly. Yep.
It's
Why does every bank not have that? That's like, it just seems so like, the whole system's so broken.
We actually have people, like, I'll have agents say, like, I want that quick wall. So, like, they have asked, customers to, like, give us a second opinion, like giving us an opportunity because they really want our letter or, you know, but just because you're qualified for $250 doesn't mean you're really qualified for $250.
No doubt.
Taxes are a huge piece of that payment. So if you're qualified for $250 and they're assuming taxes are $5,000, but then you find a house and it's $250 but the taxes are $6,000, you may not qualify.
Bingo.
But being able to put that in the calculator, you'll see if it's right or not.
Right.
So, right.
And that's another question or maybe statement that I hear so often is, I'm going to go to the bank and I'm not going to get qualified for everything that I qualify for. I'm going to like stay well. And it's like, okay. And again, there's no malice there. Like that you want to be living below your means. That's a good thing. The bank is, at least in my experience, not generally asking you how much you want to borrow. They're telling you based on what's going on in your whole profile, this is what you could afford if you wanted to.
Right. Well, one of my questions to a customer is, what are you comfortable with a mortgage payment?
Yeah.
Because it could be grossly different
Yeah.
to what they qualify for. I had one just the other day. I was like, well, you qualify, up to a $1,500 mortgage payment.
Yeah.
This is the price point. And she's like, no,
Yeah.
I don't want to be over 1,000. And
Right.
I was like, well, that changes your parameters because now your price point's going to be here if you want to be here.
Yeah.
So having that conversation to say, like, where are you comfortable? Because you know your budget.
Mm-hmm.
I don't know everything else you're paying out. I see your credit report, but you know your budget better than I do.
Right.
Like, what do you want to pay? What do you not want to exceed? So when I'm setting parameters, I may set what their max is versus what our max is. Just so they know, like, and then if they do go over it and you say, well, this is the house of our dreams, like, we really love it, then you call me and they say, we do want to increase our max now.
Yeah.
So
Yeah, that's something that buyers figure out, whether it's from listening to me or from going out and looking at a few houses, is and I don't even know where that spot is, but like if a $240,000 house that you can afford very comfortably, because of how competitive that bracket's going to be, is going to be not nearly as nice as a house you can buy for $275, because that little needle that, like, you're going to get a better house and you're going to pay a little bit more money for it, but it's going to be less competitive. You're going to have more of those big ticket items baked in. You absolutely should not put yourself in a situation where you're house poor. But if it's a $150 a month difference between pile of crap at $240 and a pretty nice house at $275,
you got to make a decision.
yeah, people, and again, at no fault of their own, people get wrapped up in what that big number is, and it's. I think that's actually what Tyler and I are going to be talking about later today, is how monthly payments affect everything, the way people pay rent, the way everything.
Well, and it goes the opposite too. Like, people will be so desperate, they'll be like, "Give me my max," and I'm like, Are you sure? Like, I mean, are you sure this is gonna you don't want to put them in a bad position.
Yep.
And it is a fine, like, if you qualify, you qualify. I can't tell you no.
Right.
But there's also, like, make sure it fits in your budget, because you don't want to be house poor down the road.
Bingo.
Yeah.
Exactly. Yep. Well, thanks for coming in. Anything you want to plug? I think you're the best loan officer in Buffalo, so that's a halfway decent plug there. But you're a premium mortgage. You're doing your thing. It's,
Anyone wants to get pre-approved before the craziness, just give me a call.
Totally, absolutely. I'm sure we'll put your info on the screen and all that. Thank you so much for coming in. Even I learned some stuff today, and you're the best. Thank you.
Sounds good. Thanks.
Awesome.